Hey everybody, this is Jim at SP500chart.com coming to you on Sunday afternoon about 3:45 on July 14th, 2013. Before we get started with the weekly review and taking a look at Friday, just want to remind you that the website and the video are for educational purposes only, and nothing stated at the site or in the video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research and make investment decisions that are suitable for your personal financial situation. I'm not a licensed financial professional, just a guy that draws lines on charts. So hey, let's take a look. Okay, the first thing we're going to do real quickly here is take a look at a daily chart that goes all the way back to the fall of 2011. And basically, what I want to show you in this chart is we have had a series now, even though this last one is not marked with one of these ovals. I just want to show you something that seems to be something of a technical trend for whatever reason. And that is, if we go back to the fall of 2011, we see there was a real volatile period of time here that finally kind of resolved itself in sort of an inverted head and shoulders pattern, even though it didn't include the bottom. It still was a pretty recognizable pattern that finally formed after this period of volatility in late summer of 2011. Since then, we've had a series of inverted head and shoulders patterns that have been a little bit peculiar. And I'll show you what I mean. Here was one in the late spring, summer of 2012. Really did not have much of a right shoulder at all. And it worked just like an inverted head and shoulders pattern. Coming back to late 2012, we had a small inverted head and shoulders pattern. This one right here that's highlighted in this gray oval, left shoulder, head, not much of a right shoulder at all. Well, it was my son on the phone. Anyway, I'm talking about these little inverted head and shoulders patterns. And we had this small one here, and that was actually part of a larger pattern that itself had a truncated right shoulder. Fast forward. We'd been looking at a potential head and shoulders pattern. We saw one down here, but I was thinking maybe left shoulder, head. And folks, this just doesn't qualify as a right shoulder. But it's looking like this pattern still wants to propel the S&P higher. So having gotten over this little resistance line here is important. But I think what is maybe even more important is the fact that is when we broke this orange line. Because this orange line goes all the way back to the all-time S&P high and that last peak that led to that significant 3.5-day sell-off. Now that we are over this line should have been turned into support. My idea is that we would likely bounce back somewhere around here in the mid-1650s, 1660, come down and test this support and really fulfilling the destiny of what inverted head and shoulders patterns often do. But apparently the S&P and the market in general is just wanting to go higher without taking care of that formality. Now, in a way, you can make the point that the failure to backtest this line is not really a good thing. you hear people talk all the time, in order for the market to stay healthy, we need a 4, 5, 6, 7, 8% sell-off. And you might think to yourself, well, what's healthy about the markets losing, 6, 7, 8%? For that matter, what's healthy about the markets losing 10 or 15%? Well, what's healthy about it is it takes care of that overhead selling pressure. It relieves that pent-up need to take profits, but it also comes back and absorbs as it breathes out cash in the sell-off. It then finds a place where it's ready to start to breathe cash back into the markets through inhaling, as opposed to the exhaling, which is when you head down. So we didn't really get that. What's interesting to note is I think we may be now looking at a parallel channel. That's something that we started to look at this week. And with that in mind, we have not yet reached this top point. So there is what appears to be a little bit more room for this market to move upwards. But I'm sort of thinking when we get up to the intraday all-time S&P high, be on the lookout to see if we get resistance here. There are a couple reasons why we might. A, that is the extended neckline from our head and shoulders top that formed and broke down in late May and early June. Second of all, it would line up with the intraday all-time high. Now I know the S&P and the Dow closed at all-time high closes, and there's something to be said for that. But we live in a day where people are also knowledgeable about intraday highs. Back in the 50s and 60s, I think that the average chart reader would just base the chart pretty much on the close. So if we were looking at a close and only a close, then we would be saying, wow, the markets are definitely going to go much higher. But remember, those chart readers would not necessarily have been as interested in the intraday high here, because a lot of them just charted the close. So we are over the close, but we are not over the intraday. So let's see what happens this week if we continue to move upwards and we approach that 1687 level. Frankly, I would expect there to be some resistance up there. And again, like I said, for two reasons. A, all-time intraday high. B, rising neckline from this pattern that broke down back in very, very late May. So that's kind of the long-term view. Let's move in a little bit. As far as what took place during the week, well, when we got over this orange line right here, I think the handwriting was on the wall. That was a bullish move. And the fact that the S&P was able to maintain and add to its distance on almost a daily basis. I think the only day we had down in the week, and it was just by a tiny fraction, if at all, I don't even know that it would have been Wednesday, where essentially we were flat. Was Wednesday a down day? I can look at it real quick. We'll look at a daily chart and we'll zoom way in. Oops, wrong slider. Nope, Wednesday was an up day, but not by much. There you have it. There's our 1, 2, 3, 4, 5 days all up in the week. And even though I was expecting a back test of this orange line, you can't argue with that. We did stay above our rising support line, this line right here. So there was no reason to sell. As a matter of fact, I'd never, it's been a while since the market has really shown us a reason to sell, except for that late May breakdown back here. Since then, there's only been reasons to buy dips. So I would say that's probably going to be the MO going forward for a bit longer, especially if we stay within this channel and this lower support line continues to hold. So I would use this line right here that's been working for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, almost 3 trading weeks. This lower support line has been working. So until this breaks, I would think the wise thing to do would be buy the dips. So really, as far as the week goes, it was pretty clear cut. Frankly, we did have a rapidly rising move off of this bottom back here that was put in on the 3rd, which was our short day. And even though this line has been violated, you see right here, we were staying above this line for 3.5 days, but that is a very steep line. I mean, this guy right here has got about 15 or 16 points per day at that pitch. That's unsustainable. So when we went out sideways right here, it looked like we may want to come back and do our back test on this orange line. But nope. Instead, we continue to head higher. With that in mind, again, we did not break this support line, so there was still no reason to sell. So basically, while the S&P did throw, at least I think it threw me a little curveball with this move on Thursday, the fact of the matter is, at no point did it really give us a head fake that we should sell and then turn around and go up. So I consider that pretty acceptable behavior, if you will, that nobody was head faked out of the market. At least I hope you weren't. So let's just continue to rely upon this rising line and see how long this sucker can keep working. When it does break, it probably will not mean a major downturn, because if we do get up into new high territory, that just signals to me that the S&P wants to move higher, just wants to keep moving higher. And I think I showed earlier in the week, if we look at a daily chart, that there is room once we get over that high. There's a good bit of room before we would reach anything where we would expect to encounter resistance other than some rising trend lines. And those are rising at a steep enough angle to where we could continue to move higher while staying underneath them. Does that make sense? In other words, here, use this line for example. We broke this line, back tested it, and then had a sell-off. But once the market regained its foothold, it started to move back up higher, and here we are, way higher than the 1400 or so, where would have been really one of the last or one of the few market signals to actually sell. We're never going to get over this line again. Never. It will never happen. But it doesn't have to happen in order for us to move way, way higher. Same thing with this line. Never going to get over this line again in the history of the markets in Western civilization. Never going to happen. But there's no need for it to happen, because there's way, way, way lots of room. So what I'm saying is these broken support lines, when they break, provide resistance upon a back test for only so long. But once the market regains its footing, then it can go up, but it just the move is all going to take place to the right and under these lines that had strong technical significance when we were close to them, but now that we're more than a year away, they're just fading memories. So this one probably will have an effect for a while, but I suspect eventually we will look at the chart at some point in the future and we'll say this line will never get tagged again, but it doesn't need to, because the S&P can go upwards to sideways, and by next fall, without ever having gotten over this line, by next fall the S&P could be at 1800 without ever having tested this line again or ever having gotten over it again. So I hope I didn't take too long saying that. We look to these lines as resistance, but typically the resistance is good for a back test or two, and then be on the lookout for continued higher movement, but all taking place to the right and under these lines that are now just really out of the picture. Now, if you want to say what lines are important, I would say once again, let's move in a little closer. I would say, hold on, go away. This line down here is important. This would be an important one. Another important one would be, again, on a daily chart, as we start to see some of these rising support lines that go a long way back. These could be very important. And if we sell off and we start to get down to testing these lines, that's when we start looking at things and saying, maybe we are now in significant top territory. But so far, these lines have held. So guys, that is the weekly review for the week ending July 12th, 2013. Thank you for your attention. Thank you for watching. If you are a subscriber to SP500chart.com, thank you for your support. If you're not, it's cheap. Just go to the website, see what it is. It's cheap. Go to the website, see what it is. That wasn't a technical glitch. I'm saying that because it's cheap, and you can go to the website and see what it is. You get a daily S&P video just like this one, maybe not quite as long after each day's close, and you also get access to the chart that I show you, that, by the way, updates in real time as you watch the market trading throughout the day. So guys, again, thank you for your support. Take care. Let's see what the week brings us in the week starting tomorrow, July 15th, 2013. Hey, take care.